Okay, hello everybody. Is everybody fine? Can you hear me okay? Answer why if any of those are true. Okay, so you should be able to see my screen. This is group therapy, so we can make it more of an interactive session. If you guys want to participate, that's fine, with your questions and your comments. We tend to put the chat into the screen share towards the end of one of these group therapy sessions. It's not a scripted webinar. And this month we're going to look at icebergs and stops because everybody's very excited about iceberg and stops now, especially because of the advent of MBO. So that's kind of coming to the forefront. Lots of people worried they're missing out on something. So we're going to take a step back today. And first of all, before we look at icebergs and stops, what I'd like to think about first is when we're looking at order flow, whose orders are we looking at, right? Because it's obviously, we're looking at order flow, we're making assumptions about what we see in the order flow. A lot of people make the assumption that the greater percentage of trade going on is a bit like theirs. So people tend to presume that all of the trade they're seeing is directional, okay? So when we're looking at all the order flow, a lot of the order flow that we're looking at isn't directional. It's not people trying to buy to sell higher or trying to sell to buy lower, right? A lot of the volume we see is spreads, and different markets have different spreads. So very popular in oil, for instance, calendar spreads, crack spreads. The crack spread is basically trading oil against the breakdown product. So oil becomes lots of different products as it's distilled. People are trading correlation arbitrage. People are making long-term trades, right? Somebody might get into a trade that they're going to get off in 6 months' time. There's people hedging. So Kellogg's, who make cornflakes, hedge corn. So there's a lot of trade that we see in the order flow that is not directional. Okay, it's the first time I've been asked in a webinar how long this will be. 45 minutes to an hour usually. Anyway, so the trade that we see in the order flow, not all of it is directional, not all of it is sensitive to the moves that are going to occur for the rest of the day. Sometimes people are walking away for 6 months. Sometimes people are placing a spread. All they care about is the divergence between their instruments coming back together when they're spreading or moving apart depending on the spread. Someone just hedging, right? The other part of the trade is, you know, for somebody who's hedging oil, the other part of their trade might be the actual oil that they have to deliver, right? So they're not entering because of a conviction on one side of the market, which means we can't presume anything about any individual orders. But as you try and analyze lots of orders and lots of positions, there are some assumptions you can make, right? Are people that place big orders better traders? That's always a good question. More than likely, right? More than likely, you don't get to trade 1,000 lot or a 2,000 lot position unless you're a good trader. But Air France made $1 billion loss on a fuel hedge, right? And that's big trading. Okay, it's not very smart, but it's big trading. Then we've got to think about, okay, so, are these big traders smarter? Well, they might be smarter, but they can lose. The people that I know in the prop world tend to have a win rate of about 50%. And basically what you got to think about, even if these guys that are placing these trades, some of these trades are spread trades, they're hedge trades, even if they are right about that trade, it doesn't mean they need the market to move in a particular direction or the one market. So if you've got two legs of a spread, one leg is going to, in the simplest spread, you want one leg to go up and one leg to go down, or you want them to come closer together. Now, if both of the legs of a spread go up 300 points, but the spread doesn't narrow, the spreader still hasn't lost any money. He just needs the spread to narrow. So he can be right about his trade, but the direction in any one portion of his trade, he doesn't care about, right? So there's a lot of times when we're looking at order flow, if I see like a 500 or 1,000 contracts trade at a level, I don't know how many of those contracts are hedges, how many of those contracts are long-term, how many of them are spreads, how many of them are people getting out of positions. So if we get down to the real minutia, we're going to overanalyze it, and we can't use the same assumptions we can make if we're looking at volume overall. So assumptions that you can make about positions overall, for spreading, hedging, long-term trades, you can presume that they're probably not going to react if a level breaks. So if somebody gets into a hedge, if your market's in a range and somebody gets into a hedge and buys a 5,000 lot position and your range breaks, they're not going to get out of the hedge, right? And short-term players, on the other hand, they might react when a range breaks, as that's their bread and butter trade. So here's the thing that we've always relied on at Jigsaw, right? And it's this. If you imagine a scenario where you've got, let's say, 1,000 positions, and 700 of those positions are spreads, hedges, long-term trades that don't care where the market is going, and you're in this short-term range, and you've got the 1,000 lots of positions, you've got 300 people left. If those 300 people are directional short-term traders, it's their reaction that's going to make the market move, right? So even if 70% of the overall volume you're looking at is spreads, long-term hedges, it's still the smaller traders that are going to move the market on a break, right? So one of the things we rely on then is to say, we know there's a lot of volume overall doing different things, but the short-term players are going to be the ones that react to short-term moves. And if they're the only ones doing any reacting, they're going to set direction, right? Now, does that make sense? Okay. So a few people are saying, so if it's the short-term players that send direction, and I only need like 30% of the I only need like 30% of the traders to be short-term to give me the reaction I want, what is it I can presume about any one individual order in like a 70-30 mix of non-directional to directional? What can I presume about any one order or position I see? So nobody's brave enough to answer that. Andres, right? It's not significant, right? So if you've got 70, yeah, nothing, yeah. So if you've got 70% of your traders non-directional and 30% of your traders directional, when you look at any one specific order or any one position, you can't presume to know anything about it. There's probably a 70% chance it's a directional, part of a directional position, right? But when you look then overall and say, well, I've got 10,000 positions there, I've got 7,000 non-directional, 3,000 directional, we can make presumptions that that's enough volume, even at 30%, that 30% is enough volume that if it breaks and one side pukes out, that's enough to move my market, right? Now, if you've got like 50,000 bids a level, then that 3,000 contracts won't be enough. If you've got 200 bids a level, then the 3,000 contracts will be enough. So when we do an order flow, we're trying to take like a, not a very high level view, but we're not trying to get too much meaning out of every individual event. We're trying to say, okay, overall, let's look at, you know, overall, how much do we need? How much volume do we need here for just a small percentage of short-term players to set short-term direction? Okay. So an individual iceberg could be a spread, could be a long-term trade, it could be a hedge, could be somebody getting out of a position. That individual iceberg has really, it's difficult to presume any directional bias from it because there's a good chance the trader doesn't have it themselves. So iceberg orders don't tell you where the market is going, right? But they are most people's favorite order flow signal because it is the easiest activity to read. Okay. Now, if we look at individual markets and think about how much spreading there is, if we look at the indices, there's relatively little spreading compared to some of the other markets. It's on the smaller percentage size, but the indices are really, really complex. Okay. And by complex, I mean, there's a lot of relationships there. which, as you know, if there's more relationship, there's more arbitrage. So you've got the S&P, you've got the micros, you've got the options on the S&P, you've got the ETF SPY, you've got the options on the SPY, you've got the QQQ, which is the NASDAQ ETF. You've got the NASDAQ futures and options, you've got the Dow Jones and the Diamond ETF and the options on them. And then you've got the short ETFs and the ultra short ETFs. Now, on top of that, you got the news and the economy, right? So if you think about all of those different things, when somebody can spot those two instruments from all of those that are diverging, there's an arbitrage opportunity. And also the people kind of managing ETFs, they have to keep those ETFs, maintained. So they're going to be doing some trading as well. But the indices, even though the kind of spreading is not as big as some of the other markets, there's a lot of complexity because there are a lot of different instruments. So there's going to be a lot of arbitrage, looking for little discrepancies in prices and trying to make some effectively very low risk money. Now, on the other end of the equation is interest rates. There's a huge amount of spreading in interest rates and more towards the short end of the curve. So with interest rates, the majority of trades are going to be spread trades. Okay. Crude, on the other hand, an interesting market. There's a lot of retail outright trade on the front month, obviously. There's a huge amount of spreads. They do calendar spreads. If you've ever wondered, is the volume okay now? Mark's having trouble. Everyone got the volume okay? If you've ever wondered why there's a difference between the price of this month's oil, next month's oil, the month after, there's obviously storage considerations, there's interest rate considerations. So there is a spread between this month, next month, and there's spreads, multi-month spreads. And there is obviously opportunity there to take advantage of, better storage costs, that kind of thing. There's a lot of breakdown spreads where they're taking things like oil and gasoline, right? So there's a lot of volume there, especially if you go past the front month. Other commodities like wheat, corn, metals, they're not going to follow the crude model so much. There's lots of legitimate hedging, calendar spreads. There's trades even on the weather in those markets. So the patterns you see in some of these markets, especially around our swing points, you see that way more in the S&P than the 2-year. So if you look at the 2-year Treasury and you look at a chart like the S&P, you can see the S&P seems to observe certain prices, and then you can see an instrument like the 2-year doesn't really seem to care about anything, and that's just because of the difference in balance of outright trading and spread trading. Now, somebody said, how do we know if they are short-term players when we see the orders in depth and sales or the jigsaw tools? You never know for sure who's short-term and who's long-term, but you can make an assumption based on the fact that in interest rates, there's a huge amount of spreading, right? In indices, there's less, but there's going to be a lot of arbitrage because of the instruments, right? So you're never going to know the exact amount. I mean, what you can do, you can sit there with crude and compare the months, and you'll see some trades, some matching trades going off at the same time if you go out a few months. So that I have seen that done by people before to kind of prove the existence of the spreading. And then the indices, the arbitrage and index futures, really keeping that stuff in line is happening in time spaces way below what we use. If you can imagine when you've got HFTs, you only need a small discrepancy for a HFT to diving. If you look at like the micros and the S&P, it is amazing how synchronized those two markets are. So you're not really going to get in front of the arbitrage trade. You just got to know that it's there and it represents a decent amount of the volume. Okay, so we understand that a lot of the volume is non-directional. Okay, we don't know who's non-directional. So let's look at what MBP and MBO are and what they bring to the equation. So MBP, first of all, is market by price. And that's the ladder. So what that means is the data feed that we get gives us just the information about at this price, this is the amount bid. That's market by price, right? And that's what we've had for a long time on futures markets. And that's obviously changing. Now we've got market by order, which is every order at every price. So with an MBP feed, this 2828 here on an MBP feed is just the data feed says, right, at 064, you've got 2828 bid. With MBO, that could be split into 600 individual limit orders. With MBO, you get every individual limit order. You get every change and add to all of those limit orders. And with MBO, basically, you can build your own book. You have to kind of rebuild the order book from MBO, right? Now, if you think about it, that's a lot of information, right? A lot of information, enough information where we can say, you know, comfortably, we're already close to the limits with MBP of what a platform can do and what data feeds can keep up with. If you imagine now putting on top of what we've already got, every individual limit order, that's a lot of data to absorb and a lot of data to process. Now, the other thing MBP does is when an Iceberg order refreshes, any new order that comes in, which is going to go to the back of the queue. So any new order that comes in for an Iceberg order is going to have a common ID with the original order. So you can see, okay, this order number ABCD1, they've now added a new order. They've now added 10. So I might have order ABCD1 that's still got 50 left, and they've added another 10 at the back, and I can tie those orders together. And if you know anything about software, having to match that when that new order comes in probably requires you having some kind of dictionary. Again, a little bit of overhead to processing that. So there's going to be a lot of information. There's going to be a lot of information changes, orders pulled, orders added, a lot of stuff going on in the MBO feed. Now, it also helps you see conversions of market orders from stops. So when a stop order becomes a market order, you can see that in MBO. You cannot see the stops ahead of time. So you cannot see where the people's stops are. You can see when an execution comes from a stop, right? MBO does not tell you if the Iceberg was part of a spread, was a long-term trade or a hedge or somebody exiting a position, right? So we have to make assumptions. Now, does MBO show all icebergs? And the answer is no. Particularly, MBO is relying on specific order IDs that come from something called a native iceberg. So a native iceberg is an iceberg order that exists at the exchange. So it's just an order type the exchange supports, where you can say, I want to trade this much and I want to show this much, and I want you to refresh at these intervals, that kind of thing, right? It's not quite as good as the Iceberg functionality on platforms like Trading Technologies. So with Trading Technologies, what they do, they are the biggest platform for professional traders. And what they do is they have much richer Iceberg execution functionality, and they have these synthetic order types. And those synthetic order types are actually running at the exchange right next to the CME, right? So they're actually co-located at the CME, right? Because obviously if you're going to not use the CME's order types, then you want your order types to be very, very close to the exchange. So the different kind of orders they have, lots of different kinds of orders. These is obviously they have icebergs, but these icebergs would not be visible to MBO, right? The actual new orders that are coming in will be coming in with a different ID, okay? So it's a good way to have your iceberg hidden, but basically it's just better iceberg functionality, right? So they've just got some better tools and approaches to doing icebergs. Now, if we look at the order types that they have at TT, this is just some of them, bracket orders that we've, nothing new to anybody, TT icebergs, TT if touched orders, TT stop orders. So there are orders, even stop orders, where the exchange won't actually know that that was a stop order. It won't know if it's an iceberg order. just because somebody on their trading platform said, I want to use TT icebergs instead of CME icebergs. So even though MBO does show the icebergs that they support, it doesn't show the icebergs on the world's leading professional platform, right? Okay, now, the other thing about MBO, it's not very new. Who here traded stocks in the late 90s, early 2000s? Yep. Okay. So you depending on when you got into it, it was a real dance. And you know, I can still remember some of the IDs here. You know, Knight Capital, Solomon Smith Barney, Morgan Stanley. I don't know, Wheaties. That's a great word. JP Morgan. Oh no, that's SB. What's SBSA? No, MSCO. I think MSCO is Morgan Stanley. Anyway, then I know it's JP Morgan Stanley. I'm not sure who MSCO was. Yeah, Goldman. Anyway, so we've got all of these different market makers. Now, some of those used to carry a lot more weight than others. So what would happen, you'd see a market moving down and all of a sudden Goldman would come in big on the bid. And you'd see a market would just like shrivel away from that. It was like there was a buffalo in the room. So Goldman would come in on the bid and then the market would start going up. And then all of a sudden Goldman would disappear from the bid and come in on the offer and scoop lots of stuff up. It was absolutely fantastic. So the game at that point was trying to figure out which of these guys to follow. Right. So, you know, so if you saw something like Goldman and it's like, what are Goldman trying to do? Kind of follow them, not really for like long-term all day trades, but for getting in, you know, either like kind of a refined entry or getting in on a short-term trade. And this is what happened with level 2. And that is what MBO is, right? Because what I'm seeing there is I'm actually seeing each bid from each participant. And there were different levels. There was level 2, which was the best inside, the best bid and ask for every participant. And there was also, I think they called it Total View. It went through a lot of different names. But there was one called Total View, which showed you every bid for every participant, right? So at the moment, I can only see Goldman there once on here. On the ask side, I can't see them on the bid side. This is probably level 2 and not Total View. Anyway, people use this, they traded off it. And it was a very interesting game. And then one day, they all disappeared, right? Everybody just disappeared. And all you saw was ARCA. And ARCA is an exchange, right? So what you'd see, JPMS here is a market maker. GSCO is a market maker. But also, if a trade came in from an exchange that wasn't from a market maker, you just see the exchange ID, right? So what they could do is they could put in bids as themselves, or they could route their bids through ARCA. And if they routed their bids through ARCA, you would no longer see their name, right? And so what happened one day is all these guys, well, not really one day, but over time, all of these guys disappeared and all you saw was ARCA and they were routing their orders through ARCA. And I presume at some point that was the result of some HFT cleverly picking them off. I don't know for sure, but this kind of thing, and we're talking late 90s, early 2000s when this used to go on. Okay. So when we look at MBO, it's like, it's not really new, you know, not even close to being new. Okay. Now, if we look at why the CME have done this, now, Condon, you can, it's not really hiding icebergs. He's saying, I thought you can't hide icebergs and indices. You're not hiding icebergs. You're not using icebergs. Icebergs are an order type that the CME lets you submit to them. So you actually give them all the details of the iceberg, right? But if you're using TT, Trading Technologies, it's just orders. The CME doesn't know that they're icebergs. And to be honest, from an MBO perspective, if you look at what MBO is supposed to do, why the CME gave it to us, it's simply because if we go back to this, right, this is what you have, or what you used to have on level 2. We've got a lot of different players. If you look at level 2 now, it gives you a long list of people. Some of them will be market makers, but most of them are exchanges. And what you'll see is there's a lot of exchanges on NASDAQ, a lot, right? So on NASDAQ, you can purchase order flow to buy the right to execute people's orders, right? And there's all these exchanges. So let's just say there's, I don't know, 30 or 40 exchanges on NASDAQ, whatever the number is. We know some are dark pools that we can't see, right? But for an algorithm, there's a big advantage to having all these disparate exchanges. And one of them is doing something called latency arbitrage, which has probably died out now, I imagine. Latency arbitrage is to take advantage between disparate prices on two exchanges. There's something called quote stuffing, which is where you send so many quotes to an exchange that it lags the price and then you arb it. I think that's probably illegal by now. But with stock markets, like I say, you can order something on your TD Ameritrade account, but there's a good chance that your trade doesn't get executed by TD Ameritrade. They give it to Knight Capital, and Knight Capital executes it. And what Knight Capital get from that is they get knowledge, right? They get knowledge of which side people are trading. So they're not supposed to front run your order. So if you have a big order and you put it into TD Ameritrade, Knight can't put an order in front of that. But I don't think there's a rule against them having a bid there, and if they see lots of selling coming in, to pull their bids, right? But there's obviously a reason people like Knight Capital are paying TD Ameritrade and people like that for this order flow. You can't do that on futures. You can't buy order flow on futures. There's just one exchange. You want to place an order, it just goes to one place, one way, right? So for HFTs, the equity markets are a bit more attractive. Because there's a lot more different strategies and because they can buy order flow. Okay. So what the MBO is doing is it's trying to level the playing field a little bit by giving HFT algorithmic traders better visibility of their orders and their fills, right? So it helps you understand why you are or aren't getting filled on your position. So if you imagine you're placing like 250,000 bids a day and 30,000 of the ones you didn't get filled on would have been profitable. MBO is supposed to give you information about all of the orders around you so that you can actually improve that fill rate. So if you could get filled on another 5,000 bids that would end up being profitable, that's a big difference, right? So it makes the CME a bit more competitive for HFTs. That's what it's for, right? If you, yeah, sorry, Carl, somebody just asked about recording. Yeah, that's fine. It will be recorded. Condon, there's no dark pools and indices. I really don't know. I don't know what instruments are in the dark pools, but there's none on the index futures, right? MBO pitch to retailers. So the MBO pitch and the iceberg pitch, or the actual being able to see these icebergs, the pitch is icebergs are definitely professional traders, which I agree with, who are right more often than they are wrong, which I don't agree with, right? So obviously if somebody's putting in an iceberg and they're buying 1,000 contracts, they probably know what they're doing, right? But this idea of right more often they are wrong is just troubling because, a lot of people trading, not professional trading, don't have an opinion on that individual market, right? So even if he's right, the success of his trade might not depend on the market going a particular way. It might be, if this one, if they both go up, I'm fine. If they both go down, I'm fine. I just need them to close the gap. Okay. Don't know if he's getting in or out. And in my experience, the professional traders I know are only right half the time. So if we look at all of those things together, right, I agree it is probably a professional trader, but, and so let's just say they're right more often than they're wrong. So let's just say they're right 70%, right? But what about the guys? So let's say 70% of icebergs or the traders placing icebergs are right 70% of the time, right? What does it do to the odds when he's not a spread trader? If I'm considering, right, he's right all the time, but then I'm going to take a directional position, what does that do to my odds taking a directional position if he doesn't care about what happens in this market? If he's not taking a directional bias? What does it say if I follow that iceberg? What does it do to the percentages if he was actually getting out of a trade, right? So these things are really going to make a difference to, if you're saying that guy's right all the time, yeah, he might be right, but he might not be making money if the market goes up, right? He might be right, but he's getting out of his position. So if you listen to Buzz on MBO, they're saying exactly this. They're saying basically, you know, a couple of years ago, everybody was being told if you see big market depth, step in front of it because that market's going to hold. Same thing with this. So it's always going to be more nuanced than see this, do this, right? Everything is. And in case we can still use icebergs, but let's not be so simplistic about it. Obviously, people want to believe these things because if it is that simple, this is just a pro trading. You can follow him. You're going to make money forever doing something that a monkey could do, right? In fact, you could probably train a monkey to do it. Just like get the PZ to beep when he sees one, get him to press buy and sell and go to the beach. And, you know, it's very rare to hear of somebody in this business that's made money like that. Now, why do people want to believe this pitch? Well, it's fear of missing out, first of all. Somebody's got something you haven't got. Obviously, that makes you worry. Your trade's fairly uncertain, okay? And you believe this will give you that certainty. Well, there's nothing you've seen so far that makes you feel certain. I don't think there is anything. Trading is an uncertain game. You know, you can be confident, but to know that the next trade is going to work out is not confidence. That's way ahead of where I see most people getting in trading. So there's an element of uncertainty with every trade. And as the trade progresses, you either kill it or it starts going your way. And that's when you get the certainty. You don't have the certainty before you get into the trade. The other thing is that every few minutes on my email, sometimes I'm getting emails about killer systems with 90% win rates. And that's kind of programming you to believe that there is something out there that can do that. So it is a bit of a magic bullet, believing this. It's perfectly natural to think that, you know, okay, this is it now. This is the one thing that's going to make me money. Okay. So we're not against icebergs. We do like them, but they're interesting for a couple of reasons. And first of all, it's size, right? It's the size at a specific price is exceptional when an iceberg executes, right? Or I'm saying that, but nobody's going to do an iceberg order where they're going to say, right, I'm going to buy 10 overall, but only show 4 and then add 1 at a time, right? That's not really an iceberg, right? So we're interested if you show 40 and buy 300, but ultimately it's the 300 that we're interested in, right? It's the amount that actually executes that we're interested in more than the fact that they hid, okay? Now, the fact they hid and didn't show their size, well, the first question you've got to ask, why would they? There's like no cost associated with this, right? You can hide your size for free, right? So why would somebody want to hide their size? Well, why would you want to show your size? Which should be the question. They don't want to get front run, for instance. If they're looking to exit a position and they've got a big position built and they bid, they've got a 2,000 contract position and they just try and exit that all in one go, right? With a limit order, people are going to see it, right? People might front run it, might never get to that price. Another reason they put in iceberg orders, and we're going to look at this later, is that they're playing games. They're actually pushing the market around, and we'll look at head fake in a minute, which is a pretty popular way to kind of game the markets. So in those situations, that the iceberg is kind of a part of a play, which we'll look at. And it's one of the easiest things in the order flow to see. We love that. We love that people can see icebergs within their first few days of looking at order flow. We're just disappointed that some people don't look past that. So order flow makes you think, oh, wow, I've never seen that stuff before. Okay. That's a really good thing for people who are studying order flow and want to kind of get some confidence that it's relevant. Downsides of icebergs. One of them is that size trades at a specific price. So one of the downsides of an iceberg, if 1,000 contracts trade at a price, somebody might come across and nudge them around, right? Which is a downside because you really don't want to be in the middle of a battle between two sharks with your little one lot, right? Another downside, people try to build a trading system purely around icebergs. And it's usually see an iceberg, sell. That's simple, right? And it does distract people away from order flow signals that are a little bit more subtle, maybe a little bit harder to spot. But generally speaking, it's the size. So, if the average size at each price is 50 and we trade 2,000 at a price, it's a good heads up. Doesn't matter if it was an iceberg or not, right? It's a good heads up, right? It's a potential good risk reward setup, but it's going to depend on context and location. Fact that they were hiding though, you know, if we're normally trading 50-11, we trade 2,000. The fact that somebody hid to do that is probably not the most important part as the fact that 2,000 people just traded into that price. So it's that absorption that causes a reaction. People, for instance, selling and seeing the market's no longer moving down. People getting spooked because they sold a breakdown, getting out because they're in profit, or being just because they, you know, shorted against the trend and it's no longer moving. So this whole concept of stuck traders, it really applies not just to icebergs, but to anywhere we trade a lot of volume at a price, right? And people are going to get spooked out of trades at different points, right? So if you're in the middle of a range and you see, you know, a lot of volume trade, is not that important. If you've just broken the range and a lot of volume trades on one side, it might be that the people who broke the range are getting stuck. And if they're new positions, which is likely because it's a breakout trade, then you can have people spooked. So there's always that kind of play that's going on. It's like who's likely to be positioned and who's likely to be getting stopped out. For Jigsaw, the way we detect iceberg orders is algorithmic. We do not use MBO, and I'm not sure if we ever will, to be honest. Mostly because it's really only showing you some of the activity. What we do, we detect refreshing at the price. We don't look at individual orders. We look to see how much was added at price. It's not specific to a particular order type. You couldn't hide from it. So if we say there's an iceberg there, then that means that price was refreshed. It's impossible to hide from that. It's self-tuning, and it's definitely not a magic bullet. Now, what we're going to do is let's have a look at how to identify an iceberg in Jigsaw. And we'll take the most simple example, right? Can we see the little blue circle up here? So we've got this little blue circle up here. Who thinks that was probably an iceberg and who thinks it wasn't? Yes or no for iceberg? No, okay. From somebody who said no, do you want to explain why? See if we get somebody to explain. Yeah, because it's visible. There you go. Right. So, absolutely. So, this shows an area where we've got a lot of market depth. And when we got there, we executed a lot of size. So, that probably wasn't an iceberg, right? Because they were showing size and we got there and we traded size, right? Now, what is interesting about this is we also got icebergs, or we also got a lot of size traded here on the Dow and here on the NASDAQ, right? Now, if I look at, we'll have to go to a different example in a second. But basically, that's not an iceberg. Now, what is interesting about this? Okay, the interesting thing about this, it's after a couple of other areas, we've got a spike up, and it's after a couple of other areas where we've traded a lot of size. At this price, it was mostly buyers, which means buyers carried on buying. Sellers didn't really sell as much into that price. Primarily, that's probably because the people selling were sitting there on the offer, right? So that is an iceberg. If you want to know, that is not an iceberg, sorry. So if you want to know how to spot an iceberg in Jigsaw, it's very simple. If you have a white line and then a large circle, it's definitely not an iceberg. And then if we've got this one case here, that's not an iceberg. There is no market depth leading up to that price, right? So can we see the difference? There is no liquidity. We don't have the white line leading up to that. We just traded and got a lot of size. So yes, yes, you're right. So if it was a white bar, so we look at the white bar here. This white bar indicates a lot of market depth. And then the blue circle indicates an area where we traded an exceptional amount. So we had a lot of depth, traded a lot there, and the market kind of turned around on that. This one here, we'd actually traded a little bit down here and then hit this. So that was an iceberg that came down after we traded a bit of size. And so that, yeah, could have been an iceberg. This is an interesting one, because what we've done here, we've moved down and then pushed back up a little bit, and we've traded a lot of volume into the ask, which means you've got a lot of buying. You're going to see a lot of these areas where there's a lot of volume all the way down in a trend, right? It does not mean that somebody's trying to hold the market every time, right? If you're short, you can get out with a bid, right? So if you're a short position, of course, there's going to be people on the way down here who are accumulating their positions, and then they just want to get out, right? So you've got to expect that in a big move down. This one here, does anybody want to think this one is an iceberg? This red one. Okay. So we can tell it's an iceberg for a few reasons. First of all, there is no market depth for it. So the depth that came in there was not visible before we got there. Now, the other thing we can see, I've just got a couple of snapshots basically of this. What we can see as we got down there on the depth and sales here, we can see we've got a bid of 24 contracts, right? And we've currently traded 195. People have sold, and we've got 8 contracts that have been bought. So 195 contracts showed, 24 contracts displayed, right? So that means that we've added actually, I think we must have gone up and come back down there. So we got, this time round, we've got 154 being added. If we look over here a little bit later, we ended up with 362 sell market orders into that bid. So basically we sold 362 contracts into that bid, into that offer, sorry, no, into that bid, sorry, and we couldn't move down, right? We can also see if we look around, yeah, 362, is it significant? Well, if we look up, yeah, that is significant. Right, so that is absolutely an iceberg order. Doesn't mean that the market is necessarily going to stop right at this point, right? But the interesting thing is we do have this little bit of a range over here, okay? So you could potentially say, you know, maybe that was somebody trying to spoof that range, but it's very tenuous. Back up here at the left, I've got the market depth. We hit it once there. I've got the market depth. We hit it again there, because that cluster. So these circles only appear when a lot of trade occurs, right? Now, can somebody tell me if this is an iceberg and this is an iceberg? Okay, look at these two. If they are both icebergs, in what way are they related? I like the answers. Hey, Matt, it's a trick question. They are related, right? So the other thing we've got to remember, not only do we not know, you know, what any individual iceberg is, but this order here and this order here, they're not related. So if we start building indicators, plotting plotting indicators based on accumulating what's going on in these icebergs, we're plotting a data series of things that are completely unrelated. You know, if this was somebody trying to buy up this market, or even somebody, you know, absorbing these buyers to short, this activity here and this activity here, there's no relationship, nor this one, right? So this could quite easily be somebody stepping up and exiting a short position, right? That doesn't mean there's any relationship between this and this. So as we go forward with like MBO and icebergs and all this stuff, look out for people creating indicators and oscillators and all this kind of stuff on this information, because this stuff, to me, it's done. When you see each one of these things, it's done. It's got very localized impact. And when you move away from it, it's going to have no bearing on what happens next. Okay. If we look on here, this one here, the yellow arrow, this is an iceberg, right? We had a little bit of depth, right? And we hit that first here, but then we hit it here. And what we can see, we've got 548 contracts added there, 576 added here. There is no imbalance. And we are actually kind of in the middle of a range, like a short-term range where we've gone up and down. We're kind of in the middle of a range, right? So there's two icebergs that effectively cancel each other out. Right, so the fact there's an iceberg there is a lot of trade there, but it doesn't really tell you anything about one side over the other. But the other thing is, if it's in the middle of a range, you tend to get a bit more trade there in the middle of a range, right? So again, what I would say is, you know, you've got areas like this. It's quite common when you start moving sideways to just start, you know, blotting all these circles, because you're actually moving sideways and you tend to trade more heavily in the middle of a range. Then when the range came down and we popped up here, just ignore this stuff out. There's got to be some kind of contextual thing going on. There's got to be a reason to want to get into a trade. And if you're looking at a range, the thing you need to be looking for is the flip. Okay. So this is where you're going to start to look at what's an area where I might expect somebody to iceberg, right? So the flip is a very common play around ranges. It's not something you'll ever see happen in a trending market. It's not something that happens because of news. It happens when the market dies, which, as you know, the market's going to go sideways. When we look at a market going sideways, are you all comfortable with trying to understand or having a good perspective on where stops are? Do you feel comfortable with knowing where other people's stops are? Yeah, we should be, because basically if a market's moving sideways like that, where are the stops? They're going to be above the range and below the range, right? Because that's where people put their stops and range trades, right? The flip basically is what happens is the market gets nudged up, right? So there's an assumption, there's an assumption that outside of that range we have stops. But there's also an assumption that outside of the range, we've also got some breakout traders. So if you can nudge the market up through this point here, you can start to trigger stops, which is cool, right? The problem is, so you're going to trigger buy stops by going outside of that range. And then you can put your limit order up here to kind of get out of your position. So you can buy, push it up through here. Everybody else is going to buy, and then you're going to hit your limit order. So let's say maybe you could, you know, in days of old when the S&P was thicker, you might have been able to accumulate a position of like 5,000 contracts over like 5 or 6 ticks. Let's say you've got 5,000 contracts you're going to get into this position, and you've got a limit order up here to sell 5,000. Who is going to stop it? Who is going to take a breakout trade above the range if there's a limit order on the sell side for 5,000 above? But nobody, right? Absolutely nobody. So if you're going to push this market up, you've got to hide up here. You have to hide, man. It's not going to work. So you've got to show like 100 up here. So what happens is the market gets pushed up, breakout traders get in, shorts get stopped out, and then they get up to here, and people keep buying and keep buying and keep buying. And all of a sudden you look, wait there, I'm buying. Everybody else is buying around me. Why are we no longer getting anywhere? It's because the person who nudged the market out of the top of this range is the guy refreshing on the offer side. And that's called a flip. What typically happens with that play is the market gets pushed down. So that's not somebody taking a directional play on the market. That's somebody nudging the market around, right? And it's not illegal. That isn't illegal. As far as I know, that's not illegal. I know there are some manipulation things that manipulations that are illegal. I'm not sure of the flip. And I say that because you can see it quite often. It's going to happen more at like lunchtime, summertime, when the market slow down. Nobody can do this kind of thing if the market's got some pace, right? So if the market's moving in a direction, it's just far too dangerous. It's got to be done when the market's a little bit quieter. Now, let's look at a backstop, another use for an iceberg order, right? So a backstop, I would call, like I often call them hidden entries backstops. When sometimes you see a market pop out and then you have a huge amount of volume and then you pop out, you can actually lean on that a little bit. So you see a huge amount of volume trade as the market's moving up. you haven't really got a pullback, but you've seen a lot of volume. Again, sometimes that's a good line in the sand. Iceberg, no iceberg, doesn't really matter. But that's another use for icebergs. They're good for pullbacks when you actually fall back to a pullback, but they're really good when there hasn't been that much of a pullback at all. So, you know, you're on the S&P, it pulls back 4 ticks. You know, we see a lot, sorry, you're on the S&P, let me explain this properly. You see a ton of volume, it carries on 3 or 4 ticks, you come back, you're not really in a position where you've got a proper pullback yet, but the market's not pulling back. That's one of the places you can get in, right? Now, look at another example. This is an example of using the iceberg as a backstop, right? So what we can see here, we've got a cluster of volume. We don't have much depth. We can see it kind of goes light, dark, light, dark, light, dark, but it's not really light when we get there. So we can see this volume here, you know, especially we can see this is mostly buying. This is mostly buying. This is some people adding to their position. And we can see that the market's not really pulling back. It comes up a little bit more. And then you come back to this point where we traded that volume, right? That's a good little backstop on a market that's not pulling back. It isn't the highest probability trade in the world, right? But it is a trade where your risk reward is very well defined. So basically what you can say is, well, we had this cluster here. We managed to go up through it. If we come back down to that cluster, you know, there's a lot of people who did take the other side of that position, just got washed out a little bit. And we come back to the cluster, you know what? They might just say, there might be some people still in short. Market comes back to the top of that cluster, you know what? They might say, I think I can just get out now. You know, I've come back to my area. I shorted. I don't have much risk there. That's when you come back and you say, right, I'm going to scratch at break even or near about. And that's really what that trade's all about. So again, you got your iceberg, but could just be volume. Market pops up, pops back down there, gives them a chance to get out again, and they buy and help the next little move up. Now, unfortunately, that move didn't last much longer than that. But again, another use for an iceberg. A place where you don't want to play an iceberg is middle of the range, right? So you will see this all of the time, right? Market moves up, moves down. We've got your range established. I don't know why we trade more volume in the middle of a range. You know, it is the area because we keep sweeping back and forward through it. But for some reason, in the middle of a range, we tend to be fatter. It is like a distribution curve. It doesn't mean anything. An iceberg there, to me, just does not mean a thing, right? You'll just see them all the time, okay? Move on to another example where you don't use icebergs. If the market is just moving in one direction, you're going to get iceberg after iceberg. And the best thing you can do with those icebergs is ignore them. So this is why you do not fade every iceberg, right? So sometimes we don't care. Sometimes we do, sometimes we don't. Edge of a range, right? Slightly different scenario. Quite often you're going to get icebergs at the end of a range. And quite often with ranges, they don't, the order flow at the end of a range is quite tough to read because from my perspective, pretty much every time it goes to the edge of a range, it looks like it's going to hold, right? It's just, you know, the way it rushes there. And so quite often the order flow is just, it'll go right to the edge of the range and just turn around, right? And you don't really get a good chance to get in. With edges of ranges, we have better chances. So here's a range being formed. You've got the edge of a range here. You can see this one here, we had the market depth before. That's not an iceberg, but it's still volume. This is an iceberg. This is just, they were bidding that already. You can see the icebergs. They actually came in on the offer there just as we got to the top. So they actually refreshed just before we got there. But again, it's all the same thing, right? It's just people diving in. You can see that's actually quite consistent sometimes, right? Now, the other thing you can see, this stuff in the middle, you just see, you know, these icebergs form in the middle. They just don't mean anything, right? Okay. What we can see right now, as we're down to the bottom of the end of this range this time, if we just look at the type of volume that we're seeing on each side, as we go up, you know, 146, 147, seems to be at the highest, 475, way up there. But we can see the volume on the way down wasn't significant. Now we're at the edge of the range again, 508 trade, right? That's why people like this kind of thing. Doesn't make it right all the time, right? But from a risk reward perspective, what is better than saying, right, I've got this potential opportunity here because I can see I'm at the edge of the range. I can see a lot of volume is traded. I've got potentially up to 3066, maybe 3069 as my upside. Where's my downside here? 59.50, 59.25. It's just risk reward. It's pure risk reward, right? It is not a guaranteed trade by any measure. If you turn it into a long-term investment, that's you not following your own trade rules. Okay. Now, the other thing that MBO can show us, and something else that people like to use a lot, is stop runs. Now, a stop run is not the same as a stop order, right? A stop order is just an order type, right? And a stop order is, generally speaking, it's an order that got turned into a market order, right? So you got stop if touched, you got stop limit, volume stops, and just regular stops. And so a stop turns into a market order. So the order that you see is the market order. You don't get to see the stop order where it's lying, but you get to see when the market order executes, so it's converted from a stop. Stop runs are when stop orders are all concentrated in an area because that's where people have got their stop losses, right? And the idea behind a stop run is that price moves into an area and fires off the first stops. And those extra stops firing off, moving a little bit more and fire off some more stops. And you effectively get this cascading motion as prices push through stops. Because they're not all at a single price, they're at multiple prices, right? It's a cascade of events. And it's almost certainly short-term traders exiting. Right? That's what we can presume. Now, if we look back at what we were talking about earlier, we don't need all of the traders in an area to be short term. If we've got 10,000 trades in an area, 3,000 of them getting asses kicked is enough for a stop run because the other 7,000 aren't even watch it anymore because they put the position on and they've gone to walk away, right? They don't need to watch it. So it's the short term traders stopping out that create a stop run. You get it after consolidation. You get it below swing lows, above swing highs. So we're going to assume stop runs in certain circumstances. But remember, stops themselves are just an order type. You can't count or plot stops executing over time just in terms of stop orders. It makes zero sense. Pretty much everybody who gets out of their position does so with a stop order, right? If you imagine somebody who's got a trailing stop, right? The amount of people who use trailing stops to try and, let a position run. A lot of people get stopped out of their positions when they're making money, right? So getting stopped out of position doesn't mean you've lost. It could just mean your trailing stop has got hit. It could just mean, the position's gone that far. You're just trying to lock in profits by moving the stop manually. So counting the number of stop order executions is rather silly, right? Because it's got nothing at all to do with stop runs, which are specifically to do with a lot of people getting stopped out at once. So how are we going to see that in the market? Well, what we've got here, we've got this small sideways range, right? So we've got what appears to be an iceberg here, no impact on the market. We've got some, we've got the iceberg we looked at, that accumulation area there. And then we've got this area here. So what we can see, we've got sideways motion. We saw a lot of people try to sell that market off. We saw an iceberg on the bid side. So a lot of selling into that area. What do we know about this area? Is that a lot of people are engaged, right? So we've got a lot of volume as we've moved sideways. And basically some bidder tried to hold that market and boom, they went through him, right? And that's he went down. That stops, right? So we built that small consolidation area. That looks more like a stop run. Okay, might not be, but this is what it looks like, right? And the reason we think it might be a stop run is not because of this move. It is because of the consolidation. It is because it looks like the market's holding, right? It looks like the market's holding. Bidder took a position there, probably thinking the market was holding as well. But we can't know for 100% sure. So when it breaks through, we can probably say that looks like a stop run. Okay. Now, if we look on the depth and sales, we've got this thing that we call momentum tails, okay? And momentum tails were actually built to find this kind of action. So what we can see is the momentum tails, the way they work, they highlight the bids and offers, but each highlighted price gets slowly darker every half a second until it goes back to the background color. So the deeper, kind of more pronounced reds and blue background there are the most recent orders. So we can see a long tail means a fast move. So as we've moved down there, we can see, obviously we can see this is a time-based chart, right? We can see a big move for the time interval relative to everything else. We can see the trading here. In the stop run, you can actually see the amount of volume that had built over time. And you can see that stop run initiated as we broke down through there. Obviously, you can see this in the volume profile, this high volume node. And you can see that we triggered and moved down very quickly. That's what a stop run looks like. But to be honest, a stop run looks like a big move on any time-based chart, right? Okay, if this was a weekly chart, you wouldn't see it, obviously. But if you've got a fairly low time frame chart, if you've got an area consolidation or you're below a swing low and you see a really fast move from out of nowhere, or sort of really fast move as you break, then that's a stop run, right? That's kind of how simple it is. And you can see again, the volume's usually on the high side. Volume's usually on the high side at each price because it's just hitting directly into the bids. And it's a very quick move. So there's probably some bidders that didn't get out of the way when that broke. Okay. So that's what a stop run looks like. But even when you see a stop run, it doesn't mean that the market's going to reverse and turn around, right? So if you've got, for instance, a head fake, you're going to see a stop run to the upside, right? And somebody try and stop that by refreshing on the offer. Doesn't mean they'll work. In that case, the stop run is because you've broken, right? Now, the absorption above it that kind of traps the buyers, that's the sign that the market's going to turn around. Another stop run, for instance, where you break a range and you just move up and then pull back without that absorption above, without the head fake, that's just a pullback. So a lot of the time when you're in a trend and you just get a short-term range, when we push out that short-term range, yeah, we get a little stop run as the shorts in that area realize we've got a continuation up. That doesn't cause a reversal. That's continuation, right? So a lot of times the stop run will be simply, we've made a move up and then we've had a small consolidation area. And then as we leave that consolidation area, the people that went counter trend will get out of the market, right? So that is when you can say, well, that's a stop run, but it's not going to make the market turn around, right? A head fake, yeah, that's going to make the market turn around because it's a stop run into somebody who nudged the market out of the range, right? So is it a stop run after a small range? Is it a stop run after a long period of absorption? Is it a stop run that's now got an iceberg order ahead of it? Okay. But basically, it does tell you something interesting. The most interesting thing about a stop run, right, is if this market, obviously some people went long across here and some people took long positions in this area and they've got stopped out. And one of the interesting things about after a stop run is when you come back to this area consolidation, it usually holds or quite often holds because the people who got stopped out and bailed out of their longs aren't going to just go long again because we got back to the same price. So it almost gives you like a future imbalance, right? So if people got stopped out in an area and you go back to the area, are they going to do the same thing again? And the answer is possibly not. So the key with stop runs, the stop orders are irrelevant. It's the stop runs that are relevant. And to get a stop run, you have to have an event to cause a break, like the break of a high, a range break, something like that. You need a reason, or like a swing breaking. So you need a reason for the stop run, but it doesn't mean that the market will continue or not continue. It just means that if you go back to the area you just came from, there could be an imbalance just because people got stopped out there. Has to be a fairly obvious location, right? Last swing low is a good obvious location. You're not going to get a stop run in the middle of a range, right? So it needs to be a nice obvious location. You can't see the stops ahead of time. You can see the conversion to market orders in MBO, but you should be able to see stop runs anyway. Now, do any of you feel that you can already feel stop runs just from basic charts, or do you feel you need something else? Yeah, Sean, MBO doesn't show stop orders. It only shows them when they get converted to market orders. Okay. And it's got nothing to do. It's literally just orders. You cannot presume they are doing X, right? All you can presume is they got stopped out. If you're not sure, it's probably not a stop run, right? Okay. But basic charts are going to show you most of it. Icebergs. Why we want to see them? Well, icebergs, it's the stopping volume thing. It's a theory that's been around us with footprint charts, right? It's legitimate. It is legitimate to look at stopping volume. You just can't presume all volume is there directionally. So you can't presume if the volume you've got at a price that you're analyzing is 5 contracts, you can't presume anything. Once you've got 1,000 contracts or 100 contracts, you can presume a percentage of them are short-term directional, and you can look for them to react. So the iceberg thing, it's generally about stopping volume, right? It's just a slightly different added dimension that they're hiding, but it's hard to see that is the most important thing, more than the volume. It's always giving you good risk-reward trades. That's always what it's been about. You have to use it contextually. So large volume in the middle of a range doesn't mean anything. If the market's tearing down, don't presume that every iceberg is going to stop the market. So you can't watch a market tearing down and take every area of high volume as somebody now taking a directional stand against the market that is right most of the time, right? It gives you a hidden backstop. And just hidden backstop means hidden in terms of you're not really going to see it in your charts. And it's a piece of the puzzle. All right, it's a data point. It's not a strategy in itself. Does mean somebody was hiding, but then why would you want to show your size anyway? You know, that's one of the things that gets me about icebergs is like, who wouldn't hide, right? You know, you really don't want to keep putting in, like if you're trading 1,000 lots and for some reason you're getting, all in one go, you're not going to want to keep bidding 1,000 and watch everybody else get in front of you in the market move without you, right? It'd just be really annoying. So it does mean somebody was hiding, but like you have to ask the question, if somebody's not hiding, that's probably more suspicious than the somebody that is, right? Okay, so the myth of icebergs is that they are placed by bigger traders who are right most of the time. Who after this, who believes that? Who believes that iceberg orders are traded by bigger traders for most right at the time? Right. Some do, some don't. Okay. Well, it could be right most of the time. Even if they are right most of the time, some of them aren't going to be directional. Some of them will be short term. Some of them might be exiting a position. It's like literally just an order type. So with an iceberg, let's say you saw an iceberg on the bid side, which is a buyer that is absorbing sell orders, right? Does that mean it's going to hold more than half the time? Considering they might not be directional, might not be short term, and they might be exiting. What would the percentage be that they're going to hold? Somebody want to guess? Is it 50? Is it 100? Is it 80? Is it 10? Okay, 50-50. Okay. I would say, well, 50% is an interesting question, an interesting response, right? Because in theory, at any point in time, it can go up or down, right? But actually, if the market's heading down and that's a buy-side iceberg, it's less than 50% because the market's probably going to carry on. But yeah, 50%, if it's less than 50%, right, you could say, well, I'll always fade it. So really, you're probably going to get a best 50-50. But then a lot of those times when it's 50-50, that's just down to general probability and absolutely nothing to do with the iceberg, right? So can you also tell me, what do you think the chances are if you buy at any particular point in time? Well, they don't type this in. You know, we all know this, right? If you buy at any particular time, it's 50-50, right? So we actually need a bit more than 50-50. Okay. But there is a fear of missing out thing, right? If somebody's got something you don't want with MBO, I understand that people have a fear of missing out and want to try it. What I would say is, if you do go for one of those solutions that are heavily built on MBO, just give it a length of time, but also spend some time proving it. And I think you'll play with it, put it to one side, and not really touch it again. So we can't put too much faith in a single order execution. We can't ignore synthetic icebergs just because they're not appearing on the CME's MBO, right? It would kind of be a weird thing to do. You know, it's just one, you know, one system is visible and one system isn't visible. So we're going to show some and not others and say, these are the meaningful ones. Does somebody want to guess, if you were putting in an iceberg order, would you use the CME native icebergs and be visible? Or would you use the TT synthetic iceberg? What would you use? TT and be invisible, right? And now, is that because you guys are smarter than professional traders, right? So being able to see this activity on there, it's interesting, right? Okay, well, MBO will show me the icebergs, won't show me all of them. What did all the guys on the stock market do? It went from JPMS, MSCO, MADF, all those guys, and then within a few months, they all disappeared. They all decided that they no longer wanted to show their size, right? So with what we do, we say, okay, don't presume too much about one order. Let's just show you everything. We've, you know, all order refreshing, and let's not worry about the individual orders because we know they can hide. Stop orders and stop runs, two completely different things. You have no interest in stop orders that aren't stop runs. People are getting in and out all the time, right? So let's not turn them into oscillators and indicators. After a move away from an area that we had an iceberg, it's the return, actually had a stop run. It's the return to the area that you're really interested in because you know you're going back to where a car crash occurred, right? That's effectively what you do when you go back to an area that initiates a stop run. Okay, what I'd like to do on that point is I'd like to stop. In terms of our plans for MBO and doing different things with it, I really don't like to give people stuff that I genuinely think won't work. And on the other hand, we want to give people things what they want. So whether we actually do something with MBO or not, we'll be seeing. We can't go around telling people that these MBO detected icebergs are statistically significant. It's very difficult to go and telling people that and saying, you know, this is so significant, it's going to, you know, it's going to equal this reaction because I'm just really not comfortable doing that. So whether we do MBO or not, I'm not sure. It'll come down to you. I hope you obviously got my opinion of its usefulness. I also hope. Well, I'll go through questions in a minute in the comments. I also hope it's given you some insights into stuff you can use in your trading. Right, TT defeats the purpose of an iceberg. It doesn't, SC. It defeats somebody using MBO to get meaning from icebergs. But like you've got two choices with putting a limit order in. You can just put one limit order in, or you can put in an iceberg. So TT does defeat the purpose of native icebergs, but there might be some advantage of the native ones, right? Like you are actually at the exchange instead of a co-located server, so it might in theory be faster. So I think the iceberg is still a useful thing to use over showing your size, because you really wouldn't want to show your size. So we're saying people don't want to show their size, so they'll use an iceberg. Well, people don't want to show their icebergs either, so they'll use synthetics. Isn't it the case that the CME's iceberg doesn't go to the back of the queue, but the price you pay is visible? No, all iceberg refreshing goes to the back of the queue, right? So if you look at the CME website and you look at the rules for icebergs, every time, I don't know if you know this, if you've got a limit order for 1,000 and you change that limit order to 1,001, the whole limit order goes to the back of the queue. Right. So if you've got a limit order on Jigsaw and you've got a limit order for 10 on Jigsaw and you change the quantity to 11, it actually creates a new order. Because if it didn't create a new order, the whole 11 would go to the back of the queue. Right. It's the same with native icebergs. Native icebergs go to the back of the queue. Right. Right, Condon, you want a stop run on high volume. Yeah, you want to see some decent volume in a stop run, because if you know a lot of people got stopped out, then that's a lot of people that will be thinking twice when you go back to that area, right? That's really, to me, what stop runs are all about. For the iceberg alert, what's my rule of thumb for setting up the minimum quantity? To be honest, my rule of thumb with the iceberg alert is it's made redundant by Auction Vista, right? So there is an iceberg alert in the product, but then this is a much better way to see iceberg. Yeah, that isn't one. That's not one, but it's interesting because they came in late. That is one there. So we can say, right, when we've got a lot of volume, but no depth, that is an iceberg. So to me, you really wouldn't need you don't need the iceberg indicator. Somebody also asked about tuning these. There's no tuning done on these circles. The circles are actually algorithmic, so it actually figures out what's regular and what isn't. So you can run, you run the same software in the S&P and the 2-year on crude, and you'll get icebergs at the right place because it tunes itself, right? MBO might be more relevant in penny stocks. I don't know. I really don't know. I'm not into those markets. If you're new to this, what's the pathway? Well, we've got some intro videos. What you can do, what I would say is, if you are new to this, just Skype me and explain your situation. Somebody's asking, when is MBO live? MBO is already live. It's been around for quite a few months now. It is live. It's just not in all data feeds. Rhythmic have done it by coincidence. Rhythmic have got quite a few algorithmic trading customers. So one of the things that not many people know about Rhythmic is they actually have a lot of customers that are in the HFT space. And so obviously they've implemented it, but they didn't implement it for Joe Retail, right? CQG haven't implemented it and have no plans to. So CQG kind of fall more on my side of things in terms of how useful it might be. Can footprint charts show where iceberg orders were placed? No, because they don't show the depth that was there before, okay? But they show where there's a lot of volume, which is really what you're interested in anyway, right? Somebody's asking about interactive brokers and IB. It's not in beta. It's been in production for quite a while. Well, and then somebody said, adding an indicator on Vista similar to Delta to show icebergs and stop would be nice. Yeah, my plan was always to change one of the things to notify to show an iceberg. But again, it's like, how easy does it need to be, right? If you look at this here, this is a circle. It's mostly selling. It's a lot of size. It's bigger than anything anywhere else, and there was no depth ahead of it. It's like, how easy do you need it to be? So why do we need it to be similar? Now, we could change the shape of that. We could do a few things, and we probably will. But it's like, I get it, but it is fairly easy to spot that at the moment. It's like, how easy do you need it to be? It does allow you to see your own queue position, which is something we'll definitely incorporate. What if somebody puts icebergs to spoof the algos? Yeah, it could be useful. If somebody implemented MBO and displayed all price, I've concerns dynamics of price discovery may change. Yeah, I mean, you can display all price levels. The problem with displaying all price levels in MBO is that you either go back to the level 2 model, okay? So if we look at the level 2 screen, right? Because the way this works is you've got lots of rows at each price. Level 2 is side by side, right? Now, if you look at that and compare it to Dome, this is a lot harder to read, right? So if you turn to a system like this for MBO, it'd be very difficult to read. If you somehow try to do it on a dome and display next to this all of the individual orders, you're going to have a problem with the Windows UI keeping up to speed. You're going to have a problem with the human eye keeping up to speed with all the changes of all the different orders. So yeah, it's the information's already out there. So the information about every order is already out there, but it's really not that useful for people making decisions on our timeframes, right? What feed people experience the best of stock? I like IB at the moment. We're trying to bring another feed online at the moment. IQ feeds, they don't have total view in IQ feed. It is level 1, which means you just see the best bid and offer per participant in stocks. So it's okay, but it's not great. IB is much better for stocks, and you've got to make sure as well that you have the right subscriptions. One of the claims of MBO Advantage is you get the entire order book depth. Well, it depends what you mean by the entire order book depth. In this case here, 101, that is the entire depth, but it's the MBP. It's market by price. So the 101 total orders at that price, or 101 total quantity at that price. MBO shows you that that's made up of 30 orders, right? But there's no additional quantity in MBO, right? You will see the same total quantity, right? So there's not any extra orders that MBP doesn't show. Stop runs, does it show a sudden drop or rise in delta? Delta should, if you've got a stop run to the downside caused by a lot of selling, you'll see a drop in delta. The reason for that is, okay, if you think about it, if you've got people clicking buy and sell, like every 100th of a second, somebody's clicking buy and sell, right? And that's your normal rate of like market executions. When you go into a stop run mode, you're going to move down and you trigger a bunch of stops, and you trigger a bunch of stops, and those stops just cascade. It's almost an immediate thing. During the time that that's happening, there's not even time for people to put buy market orders in, right? So the delta is obviously going to go to the downside. Does that explanation make sense? It's like literally, because one order's firing another, it's almost instant. So you're not going to see many trades on the other side. If we go back to, where's the stop run? Right. There you go. If you see on the way down here, I mean, we did pull up a little bit. So, but on the way down here, you can see there weren't many orders on the buy side. Okay. So we'll see the delta heavily on one side when you got a stop run. Yeah, I mean, would we create somebody? I mean, it's always the question: is it Vista versus Bookmap? We wouldn't make Vista like Bookmap. If we made Vista like Bookmap, we'd have we'd have like hundreds of these circles all the way down, right? And I don't understand what all of those circles are supposed to be doing, except just plotting on top of each other. So the circles that we show are exceptional activity. The way we do depth and the way the Bookmap do depth is basically the same. The stuff they've got for MBO and stop run, I think, well, you already know my opinion of it based on what we talked about today. I don't think it's based on any concept that plays out in the real world. Do you get more than 10 levels? Okay, only 10. Yeah, there are more than 10 levels even with MBP. It's just that different data providers do different things. Like for CQG feed, most markets are 10. I think crude's 20 on CQG, might be 30. For Rhythmic, you've got like the whole book. So you can get more than 10 levels on the order book right now, and you could before MBO. MBO does, as somebody's asking, it needs a lot more computing power. So if the market, when the market's going crazy now, if your CPU is going up, MBO will increase that. MBO doesn't change the heat map. It's exactly the same. The heat map's based on total at each price. Okay. Yeah, I mean, the thing is that more than 10 levels of depth it's nothing to do with MBO. It's just what the data providers give you. So Rhythmic have always given you more than 10. Yeah, it's like, yeah, the problem is, I mean, these tools have all got different technologies as well. So like some of the technologies are kind of, the computer has to interpret the language, programming language as it goes, and they're quite heavy. You've got to try and keep it light in trading. Does MBO help you determine whether a lot of small retail trades at a price versus a few bigger players? No, absolutely not. The size of the orders, individual orders, absolutely irrelevant, because look at the other order type. If I've got another order type, slicing large quantity orders into several smaller quantity orders. So that's another synthetic order type at TT. So again, if you are putting orders in and you've got a system where it's first in, first out, a normal queue system, and you were going to put like, you want to put 1,000 lots, everyone's got MBO, right? Would you use this to split up that 1,000 lots into lots of small pieces? Right? It's going to do it for you automatically. It's going to cost you nothing. It's not going to take any longer, right? So you will see large orders in the book in MBO if they want you to. And they won't show you if there's an edge in it, right? If they are giving, if they believe they're going to give away an edge by showing their size, they won't show their size, right? Especially when not showing their size is just as simple as setting a flag in your trading platform to split the orders up, okay? Do I think it'd be useful to see the MVP and then next to it to see how many separate orders at each level it consists of? Well, the reason I think it won't is because that's what this used to do. That's what this used to do. You can see you can see Goldman Smith here with 10. Bernie Madoff there with his 2. The reason they disappeared was basically somebody had basically figured out how to get an advantage out of knowing that information. That's why they disappeared, right? So we've got to think is, okay, now this kind of system that died out in the early 2000s, when that moves to futures, are people going to be so naive as to not realize that this game in the 2000s, that their information's out there and that could be some benefit from it? So I think really no. I don't believe, or the people that I know, the professional traders that I know that have been around a while, don't believe there'll be any value in seeing the big numbers in there, because that game already died in the stocks. These guys coming up and showing their size and pushing the market around, they obviously got their fingers burnt somehow. I don't know the details, but I don't think the futures traders will be daft enough to let that edge out. Now, there is a time when you will show a lot of depth. So again, let's not presume all markets are first in, first out. There are interest rate products where the Q position or the Q position is dynamic, and your allocation of market orders is down to size. So even if you're at the back of the queue, if you're the biggest individual within the queue, you'll be allocated more size. And that happens in interest rate markets. But the queues are not first in, first out, right? Right, and I'm not going to comment on your comments about our competitors. So that's the end of the group session. I think we've got most of the questions. Like I said, we don't know who's short term, who's long term, but we know there's a mix, and so we have to kind of make our presumptions based on that, and not too much based on these individual events. So I'd like to say thank you for bearing with me. I've been a little bit sick today, but I didn't want to delay it like last month. And I will make a recording of this and I'll post it on the site and send you all an email. And I will see you next month.